Hello, everybody. Welcome to our presentation of the Long-Term Investors Report for private participation in infrastructure. What role for public-private partnerships? My name's Tim Phillips. I'm going to be your moderator today. Today we have both of the authors of the report, Emmanuel Auriol of the Toulouse School of Economics and CEPR, Stéphane Saucier of the Sorbonne Business School. I'll let them introduce themselves in a moment when they present. Now, we have a packed program today. So in a moment, Pietro Garibaldi, the Director of Long-Term Investors at UNITO, who published the report in collaboration with CEPR, he will introduce the session. Emmanuel and Stéphane will be presenting the report. Following that, our first discussant is the Meridiam Chief Economist, Stéphane Gallon. We've got two Stéphans today. Meridiam is a transformational impact specialist. I think that's right, Stéphane. So very relevant to you. Also a corporate partner of CEPR. Our second discussant is Giancarlo Spagnolo of the University of Rome Tor Vergata. And when we have finished that, we will have time for some questions as well from you. If you want to ask questions, you'll see down the bottom of your screen, there is a little talks bubble with a question mark in it, Q&A. Please click on that, type your question in. It comes to me. We will put it to the panel. Please ask your questions early, ask a lot of questions, and hopefully we will get through them. Okay, first of all, then, I will hand over to Pietro Garibaldi. Pietro, welcome.
Hi, Tim. Thanks. Hopefully you can hear me. Yes, so hi, everybody. In case I'm coughing, I went through a flu, so I'm sorry in advance, but should be okay. So I just take a few minutes of your time to tell you a few things, since we have a packed timetable. First, what is LTI, the institution that I'm presenting today as a director? LTI is a small think tank at the University of Torino and Collegio Carlo Alberto. It was established in 2007. And its idea is that it is focused on independent research and dissemination on long-term broad sense. And this is what we are doing, and we do it in research, in continuing education, and in dissemination. So our is what is the report which we are here to launch today, and so is our flagship publication every year, exactly to engage leading and senior scholars, and we're very lucky to have two of them today, that at some point in their career they decide to, with the help and the support of LTI and in collaboration with CEPR, to basically disseminate their long-term studies on the topic linked to long-term investor. And so this is the author LTI report that we are publishing with CEPR, and is becoming now a small baby. Now is a small baby, and we are very proud. And today we have the two speakers that they will then introduce themselves. We are, of course, very proud. Emma Auriol, which is here, and Stéphane Saucier as well. And the LTI report today is the launch and publication of a process that lasts 18 months. First, we speak with the authors, and they accept the idea of doing it, and then of course they have to write and think for many months. And then another key point is when we present the report in the fall, in November 2024 at Collegio Carlo Alberto. The policy discussion as well as the discussion is all included in the publication of the report, which is then published in the spring with the CEPR. So that's what we are doing, and of course all this is possible thanks to our sponsor, our financial of Northwest East, Compagnia di San Paolo, Equita, Self Monaco, Intesa San Paolo, Real Mutual Assicurazioni. We should of course thank them. scientific advisor that we have, which is chaired by a remarkable person such as Jean-Charles Rochet, as well as the rest of the team, and all the small LTI team, my deputy director, Luca Regis, Florence, which Prushakon, which we have interacted also, she's wonderful. Thanks all the support from the rest. I think I took enough. Just last thank you, of course, the CEPR, which is the key partner in these things, and of course, so Hiroton, Tessa, Ogden, and then team for chairing these things. I think I pass back to you, and thanks a lot. And I put in mute, but thanks.
Thank you very much, Pietro, and thank you. And thank you for thanking me. I don't normally get that. I'm very pleased. I'd like to introduce now Emmanuel and Stefan, who are going to present the report. You will see already there is a link in the chat if you want to download the report. I would listen to their presentation first, but it's there for you when you want it. I would really recommend reading it. So, Emmanuel, over to you.
Do you hear me? Okay, that was the headset. Sorry. Okay, technology failed me. They didn't want me to thank CEPR and LTI and Pietro for this really great opportunity. I would like to share my screen and maybe jump right in the report. This is a joint work with my great friend and colleague, Stéphane Saucier, and we were tasked with looking at PPP, so private participation in infrastructure. This topic is obviously extremely important for different reasons, because first of all, infrastructure, and I will not spend too much time on that, are really key for growth. Although it's extremely hard to properly causally measure the impact of infrastructure on growth, because so many things happen simultaneously, all the analyses that exist, and we are quoting some meta-analysis, point out to the big impact of infrastructure on growth. The problem, of course, is that we have aging infrastructure in Europe. We have new needs because, for instance, of global warming and transition. And there is a huge financial gap to finance this infrastructure needs. It's very hard to measure this gap, but estimate at the world level are between 2.5 trillion and 4 trillion per year. So that's some big figures there. And the issue is how we are going to finance that. And this report is mainly focused with Europe. And as everybody knows, the situation, financial situation of government in Europe is not exactly great. There are many countries that are struggling with huge debt level. France is one of them, but Italy also. So maybe this is why we are working on that jointly with Pietro. And the issue is how we are going to finance it. Presumably not so much with public fund, at least not in Greece, Spain, France, Italy, etc. And so the natural idea would be to use and to rely on private funds. And it's true that institutional investors have a lot of funds to invest because of, for instance, pension plan and structural investor in the VCC of 10 trillion under management, for instance, in 2022, but they allocate only a very tiny fraction to infrastructure, 3%. And that's, of course, something we would like to leverage more. And so the idea of this report was to look at the possibility of increase public-private partnership. So the structure of the report, you will have it in the link, but we start by looking at what are the investment in infrastructure. And the thing we learn in this report, while working on it at least, is that we know very little about that. The reason why we know very little about how much is invested in infrastructure is because of the way we account for it. So infrastructure finance, you have two branches, private and public. And roughly speaking, based on what we know, it's half-half. Roughly, private is a little bit larger than public. And Private is ventilated in three blocks. Corporate is really a blind spot because it's inside firm. They invest in infrastructure and they don't communicate about that. So we don't know really. There are non-PPP projects. So these projects are to safeguard the finance of the firm, and so they do a special purpose vehicle for that. Then we have some information. And then there are PPP projects that is part of this structure. And you have also public investment, traditional public procurement, and public project. That's the structure. So what do we know, at least before we started this report, on public finance, on investment in infrastructure? Well, since we don't have detailed data at the macro level, what is used in general is the measure of gross fixed capital formation. And so you have some figure on this table, and you can see that they are all over the place, from 2.3 trillion in 2015 to 400 billion in 2022. It's not measuring the same thing. It's not covering the same type of country, nor the same sector. But the bottom line is that this measure is very gross. Why? Because it includes, for instance, if you look at transportation infrastructure, it includes roads, but it also includes truck, and truck are clearly not an infrastructure, and that's an overestimation of infrastructure investment. So this is something which is based on that. It's a caveat, so you have to have in mind that it's really an imperfect measure. And you have the decomposition between public and private. Public is in blue, private is in pink and gray. And as you can see, public is roughly half, well, a little less than half. And the yellow part is a PPP. So it suggests, this graph, that PPP is really negligible. If you look at this gross fixed capital formation, well, not much is invested in infrastructure. And if you look at the total figure, it's close to 2% of the EU GDP when measured with this rather imprecise measure. We use in this report TED data. These data are based on online data that we web scrap and that Stefan will discuss. And they are really focused on public procurement. So it's really a subcategory of this big category I just mentioned. So just to have that in mind. But it is more precise, and it is indeed investment in infrastructure for most of it. And we leverage two different directives, concession and traditional public procurement, in order to try to narrow our measure of things. So this is what you get. It's really a first picture of infrastructure finance in the EU when we compare traditional procurement work, so purely public, and infrastructure concession, so PPP. And here it starts to be not so negligible. It's between 2.5 and 12%, depending on the year, of all public investment. So it would be unfair to say that we don't care. This type of figure we care. And if we focus now on education, health, transport, and utility sector, the bracket is between 5% and 20% of all public investment. So PPP are not negligible in this when we focus on public procurement. So this is a summary of what I just said with different measures. So in green, you have TED public investment that include all sectors. In light blue, you have AEB measure, which is based more on gross capital fixed formation. And in dark blue, it's again TED, based focus on the same sector as the AEB. So you can see it's a sandwich, it's a bracket between the two. And we have really first conclusion that we have imprecise measure of investment. One very important aspect of why maybe PPP are not so popular nowadays is that they have been growing in complexity over time. So we just provide very striking, I think, example in the report for those who are interested. Starting from a few articles in 1854 to a contract that have more than 6,000 pages in 2025. So a contract with 6,000 pages, of course, is not something that is sensible, and that means average firm cannot really participate in such complex process. And empirical studies show that the writing of PPP contract absorb a very important share of the final cost of the contract. I believe, and Stefan also, that this is not very sensible. There is something to do there. What are these PPP? So there are two types of PPP, two broad categories. The first one is what is called in our database concession. So this concession contract, typically they cover infrastructure like highway, and they are on of the boat or DBFO or boat type, which basically mean build, operate, and transfer. So private sector invest in an infrastructure, operate the infrastructure and collect fees through the operation, and then transfer it back to the public. So in this process, the private investor, the private firm, has some vested interest in the functioning, in the operation of the infrastructure. And then you have contracts that have been invented. So the concession type exists since the antiquity. The Romans were using them in a very blunt form. It was a contract where you say, okay, you built an infrastructure and you exploit it in a monopoly position. That was a contract. More recently, in the 20th century, we invented avality-based contracts. The British invented that. And in this type of PPP, it's a bit different. The private firm built an infrastructure, and the payment is not made by user, it is made by the public authority based on availability of the infrastructure. So typically a prison or an hospital, public lighting, stuff like that, where users do not pay, and so the public pays. So first look at the PPP in the EU. So first of all, we see that there has been a big wave with a peak in 2007 and since then a decline. We believe that one reason for this decline is the excessive complexity of this contract. That's one part of it. What is interesting on this picture, you see that there is a common usage of both concession and availability-based contract. You have both on this graph, red and green. As I was mentioning, it's natural that for instance, in defense or healthcare, you will have more availability-based contract because you don't have user, while in transport, telecommunication, or generation, electricity, you will have concession. So the thing you observe on this graph is totally consistent with what we just discussed. What is very interesting also when you look at data is the huge variance in matter of usage or reliance of this contract. The United Kingdom is a champion at the European level, well, former EU level. France is next, and then Spain, and some countries, they don't use it at all. And when we correlate that with debt, the public debt of the country, of course, it is related. So countries that have a large debt rely more statistically on PPP. So what are the key insights? We don't have comprehensive and detailed data on infrastructure investment. PPP are rather a small fraction of infrastructure finance. The main sectors that are concerned are transport and energy, and this is true at the world level. Many countries in Europe do not use PPP yet, and they could. Maybe they can. There is a role for them. And we have also some decline in the usage of PPP, presumably because of the complexity of it. And we need, if we want to increase the reliance, and we believe we should because of the financial situation of the EU economy, we have to think a little bit more through this various issues. Okay, so what do we know about PPP? So the first thing we know about PPP is that they are heavily renegotiated. And in the literature, the academic literature on PPP, which come from regulation, really complex contract approach, this heavy level of renegotiation, is interpreted as bad governance. It's a sign of weak commitment, and this weak commitment in this type of literature is bad governance. And so here you have a number of papers that focus typically on that, the percentage of renegotiated contract, and it's always criticized as a lack of commitment. And as you can see, some contracts are renegotiated, 100% of them, so it's a very frequent percentage of contracts that are renegotiated. what do we know when we compare a PPP with what we should compare them with, which are public procurement? Well, we know a certain amount of things that are not very surprising. So PPP are generally better at delivering infrastructure project on time, especially if it's availability based, because you are not paid until it is available. So that's an incentive to be on time. At agree upon quality standard, usually they are quite good at that. And within the initially contracted price. Although we have to be careful because there is a selection bias affecting this finding, because of course, if you have the choice as a firm, you will focus on PPPs that are the most profitable, not the one that are not. And so the best projects can be awarded through PPP, while the worst one will typically remain public. PPP are not cheaper than conventional method. When we add everything, in the end, they are as expensive as public procurement, and they are very often renegotiated. That is true. So we have a little model of PPP. So for those who are interested in theory, it combines two types of approach, one by Yossa and Martimore and the other by Oriol and Picard. And the two key aspects in this model are the following. The design of the project affects the cost in the future. And so if the firm, this is a basic intuition, is in charge of operation in the future, like in a PPP with a concession contract, then it will have an incentive to have a good design because I am supporting the cost later. If I am not in charge of operating the infrastructure, I will have no incentive to optimize the cost. That's the basic idea. The second basic idea, second brick of the model, is that you have public finance constraint, and that matter for the public authority when they choose between public and private. So I am going to skip this slide. We have no time for that. Let me just jump to one result where we compare the welfare between public and private. And in this case, what we can show, there are three different effects. Basically, if the fiscal effect, so the public budget constraint effect is not here, and if the externality in construction between conception and operation is not here, then public is better. But if either you have a big budget constraint as a government, or there are a lot of externality between construction phase and operation, then very often PPP is better. So that's what we can show. And what this report add, and I think it's the main innovation there, is to add risk into the picture. Why these contracts are renegotiated so much? And what we simply say, which is, I think, sense, is that this contract lasts for some of them 100 years. And when the contract lasts for 100 years or even 50 years, you cannot predict everything. That's impossible. That would be insane. That would lead to contracts that are 6,000 pages long. And even with that, you are missing something. So you add some risk. And in this model, we add some risk that is orthogonal to the action of the firm. If you add a risk that is orthogonal to the action of the firm, independent of the action of the firm, and observable, like COVID crisis or war in Ukraine, you should be able to renegotiate when this shock occurs, because then the firm will accept a contract with a lower risk premium. That's very simple. This is what we show. And so when we take risk into account and we allow for a renegotiation, the public authority is better off. So this is what you get to measure how better off you can be. You have the minimum concession term when you have no risk. You have the minimum concession term when there is a risk and you don't allow the firm to renegotiate. So you will have to abandon rent to the firm, risk premium to the firm. And then you have the minimum concession length when you have risk and renegotiation. And you could replace minimum concession term by minimum price or minimum rent. This is totally correlated. So renegotiation, this is the bottom line, when they are well done, are a tool, in fact, to manage better this contract. They will reduce complexity and they will make them profitable for the public authority. And now I am handling the floor to my dear colleague, Stéphane. Oui.
So, share my screen.
Let me share my screen. I hope everybody is hearing me well. So let's now turn to the empirical part of the report. So as we said, we've got on the one hand the empirical literature that is saying that PPPs are long-term complex contracts that are often renegotiated. And this is a bad news because very often renegotiation is just a manifestation of opportunistic behaviors. And on the other hand, you've got this model we developed for the report that is saying that renegotiation might be a good news, especially when renegotiations are occurring because of exogenous shocks. And when you've got some kind of relational PPPs that are open to renegotiation for frequent renegotiations, small renegotiations, and non-conflictual or cooperative renegotiations. So this is what we would like to look at in the last part of the report, exploring new data on PPP modification, and public contracts, more broadly modification. So basically what we did is that we looked at frequency of renegotiation, the depth or the magnitude or the extent of renegotiation, and the nature of renegotiation, meaning the cooperative or conflictual nature of renegotiation. This is mainly the three things we would like to look at empirically at the end of the report. So to do that, we collected some information about public procurement data, public contract as a whole, including PPPs. So we used, as Emmanuel said a few minutes ago, contract award notices coming from the TED website of the European Commission. That is not new. I mean, you've got those information for a long time available online. You can just download all the files about contract award notices of all public contracts within the EU between 2006 and 2023. And you've got some information about roughly 6.5 million public procurement contracts, and you've got some information about contracting authority, national authority or subnational authorities involved in public procurement. You've got information about award procedures, open tender or negotiated procedures. You've got information about the level of competition, the number of bidders. You've got information about the signature date and the contract value that is very useful for our empirical study in this report. What is new in the report is that we also collected some information about contract modification notices. That is to say, modification is just renegotiation. So this is a legal term to talk about renegotiation. So this is completely new. This is a novelty of the 2014 public procurement directives. And you've got more than 200,000 now online contract modification notices, but they are not ready for use. So you need to scrap the data. So we scrapped the data and we collected more than 180,000 observation, more than 180,000 contract modification notices for public contracts between 2016 and the end of 2023. And we have information about the contract duration, the extent of renegotiation, and the justification for modification or renegotiation. That is very important because the justification might go into the details and explain why they renegotiate and how they renegotiate. I will come back on this. We were able in the report to distinguish different contract types. So we were able to distinguish concession contracts from availability-based contracts and traditional public procurement contracts. And we went into the details of concession contract, distinguishing service concession contracts and infrastructure concession contracts. And finally, we've got a data set because we merge both data set, contract award notices and contract modification notices. And finally, we've got a final data set that is made of more than 60,000 renegotiations and more than 31,000 contracts that have been renegotiated, including more than 600 public-private partnerships, broadly defined concession contracts and availability-based contracts. And we've got also a full sample of nearly 2 million public contracts that have been renegotiated or not renegotiated, including 1,300 PPPs. So just a brief look at contract modification, because this is completely new. And I mean, I suspect nobody saw this graph before. If you did not scrap the data, dig into the data and make the calculation, you don't know about this. I mean, one of the first results is to see that when you are considering public contract as a whole, the size of renegotiation on average is quite low. So majority of renegotiation are just changing the value of the contract by less than 10%. You've got very few modifications that are reducing the value of the contract, and you've got many renegotiations that are increasing the value of the contract by more than 10%, sometimes more by 50% that is not allowed by the European directives. So what we did, I will not be too technical, and we did just basic econometrics, and we were just looking for correlation between the depth of renegotiations, the sentiment associated with the negotiation, so the level of cooperation during renegotiation, and the probability to renegotiate. We wanted just to find some correlation between those three variables and the type of contracts that have been used. So are we considering PPP or traditional public procurement contracts? The contract authority that is in charge of the contract, so national level or subnational level, we are going more into the details in the report, but let's say this like this right now. And we control for as much as possible fixed effect. We control for the year of signature, for the CPV code that is the activity that is concerned by the contract. We've got some country fixed effect. We've got the date of renegotiation when it is useful as a fixed effect. And we've got also some information about the fact that the contract has been renegotiated because of COVID-19 or because of the war in Ukraine that are typically exogenous shocks. That is in the Z vector here in the slide. And so we made basic ordinary least square regressions and a logit regression for the probability to renegotiate. So the main results, and I will be fast because I want to let some time for the discussant, especially because he's in front of me and is starting to look at the clock. So concerning the depth of contract, the extent of contract modification, you've got two main results I would like to highlight. First, that is availability-based and infrastructure concession contracts tend to result in smaller change to the original contract value when you've got a renegotiation. And I mean, this is 2.3 percentage point less on average compared to service concession and traditional public procurement contracts. And also we found that contracts managed by regional or local authorities are more likely to undergo renegotiations that lead to significant cost increase, unlike those overseen by ministry, national authority, or specialized agency. Concerning the sentiment associated with a renegotiation, so what we did is that we just made a basic sentiment analysis in the report using one dictionary that is a Barbaglia and all dictionary. So we use the dictionary of 2021, but it has been published since a few days now in the Economic Inquiry. So you can look at the publication that is online. And basically what we want to disentangle is the sentiment, the fact that the renegotiation was conflictual or cooperative. And just to give you a flavor of what's going on, you've got two examples here coming from the data. Example one, during the implementation of the order, there were disagreements regarding the scope of additional work, leading to delays and budget overruns. So clearly here, the renegotiation was a little bit conflictual, let's say, and they disagree on what they should change and modify within the contract. Example two, the modification of the contract became necessary due to unforeseen circumstances. Both parties worked to adjust the contract price, ensuring mutual agreement on the adjustments. Seems to be less conflictual and maybe cooperative. So this is exactly what we would like to disentangle using, again, basic sentiment analysis and using this Barbaglia and all dictionary that is online on the EU website, the European Commission website, and that has been developed for the European Commission in order to study some negotiation and economic issue within contracts. So you see that if you look at the distribution of contract renegotiation based on positive, neutral, and negative sentiment, we see that looking at all the renegotiation we have in hand, many of them are ranked positive. You've got few neutral and you've got few negative compared to the positive ones. So the general assessment is that renegotiation are more cooperative than conflictual, looking at the reasons that are given by the public authority within the contract modification notices. If you make some basic regression as we did, we find that availability-based and infrastructure concession contracts tend to have higher positive and significant impact on sentiment scores. So those availability-based and infrastructure concession contracts, PPPs for infrastructure, let's say, are better ranked through the sentiment analysis, and they are more characterized by cooperative renegotiation compared to conflictual one. I do not go into the details of the other results, but we can discuss during the discussion. And the last question we were interested in is, of course, the probability to renegotiate. So here we've got, you should look mainly at the column 2 and column 3 of the report of the table that I'm showing you right now. And so we made a logit estimation on the whole sample. So you do not have 2 million observations because we reduce the sample focusing only on contracts that is more than 1 million euros and that have been in force more than 12 months between 2016 and 2023. But the main results are the following. You've got a higher probability to be, the PPPs, they have a higher probability to be renegotiated compared to traditional public procurement contracts. And when you focus on the subsample of PPPs, you see that among the PPPs, service concession and infrastructure concession contracts are the more frequently renegotiated, availability-based contracts being more rigid and less renegotiated compared to concession contracts as a whole. And another result we've got is that contracts overseen by regional or local authorities, they have a higher likelihood of renegotiation than those overseen by ministry and national entities, which are our omitted variable in these regressions. So just to conclude the empirical part of the report, I cannot see my slide, but that's okay. So what we find out is that PPPs, infrastructures PPPs, so the green part of the table, those contracts seems to be more flexible or more relational. That is to say that the probability to renegotiate them is higher. When you renegotiate them, the size of renegotiation is lower compared to traditional public procurement contract. And the sentiment associated with renegotiation is good, positive, from the public side at least. I mean, this is the public side that is giving information about modification in contract modification notices. And on the other hand, in red, you've got two kind of, let's say, problematic contracts where the size of renegotiation is quite high. The probability of negotiating is very low for traditional public procurement contract, is high for service concession, but the sentiment associated with renegotiation is negative, so more conflictual, basically. So you've got two types of contract, let's say, from this point of view. And also, we've got another result that is, just to conclude, that regional, local agency and local authorities renegotiate more frequently and more in-depth contract amount compared to other type of public authorities, suggesting that they lack the expertise to run this complex type of contracts successfully. So to conclude, and this is my last slide, we believe, and this is the message of the report, that there is an opportunity to expand and to develop PPPs to meet infrastructure needs in the context of the ecological transition. But PPPs are complex contracts. And Emmanuel gave an example, and I would like to come back on this. You've got this new water contract that have been signed a few months ago for the CEDIF in France, and the public authorities are very proud to put online some information about the contract, saying that you've got 9,000 pages, 20 volumes, and more than 20 kilograms for the contract. So clearly, those contracts are becoming complex and more complex through time. Of course, we would urge PPPs to be more simple, but we cannot have too simple PPP contract, especially because we are talking about public money and we need to protect the public interest. That's obvious. So there is a need for contracts that are both protective of the public interest and flexible enough to adapt and to remain effective in a dynamic environment. So we urge for simplifying PPP contracts by incorporating more provisions for renegotiation. And also maybe PPP contracts that are managed by specialized public entities with higher capabilities compared to local authority. So we believe it could strike an effective balance between commitment and flexibility, and it would make PPPs more viable and appealing to both private investors and public authority. And that's it for my presentation. So you see, Stefan, I'm right on time.
Thank you, Stefan. And now you have another Stefan.
Yes, thanks, Stefan. Yes, and Stefan, over to you.
Thank you. I will be sharing my screen as well. So let's go. And the usual question would be, does it work for screen mode? Correct, everyone?
Yes.
Okay, thanks. So my presentation has been prepared with Augustin Vigin, a colleague of mine. You don't have him on the screen, but he's seated next to me. So thank you, Augustin. So this first discussion, will be a practitioner's discussion. So it will be based on my experience with PPPs at Meridiam. As Tim mentioned, it's a transformational company, of course, but that basically aims at developing, financing, and operating infrastructure and PPP projects around the world, as you may see on the map. Each red location pin marks one of our assets, so they are almost everywhere except in Asia, and we have some in Italy, for instance, the Firenze tramway for our Italian colleagues online. So to keep things brief, I'll focus mainly on the final part of the report about renegotiation. And otherwise, this will be a very fairly standard discussion. I'll start with the model, then discuss the data, and I will conclude with the results. So very traditional discussion today. But just to give you some more flavor about the experience I am drawing on, here are a few key facts about Meridiam. The company was founded 20 years ago at the peak of the PPP fashion that Emmanuel highlighted. And it has focused on greenfield equity investment across the three sectors that are described at the bottom left part on this slide. The order of magnitude of our investments, the capital that investors have asked us to manage is 23 billion euros, but the projects that we manage is around 87 billion euros. And as you see, we have a global footprint, except in Asia. For instance, we have 10 offices around the world, especially in Africa. And I think that the emerging countries will probably influence my my discussion, because you have worked on a European database, and I would like to see so much more about other countries. And the most important information, of course, is at the very top of this slide. We are a proud CEPR member, of course. So let's start with the model. First of all, as practitioners, we are really pleased to see this kind of research, because it's not every day that academic work directly engages with what we do. So we are very thankful to the authors. But as with any model, of course, we have a simplified version of reality with its limitations. So one key question I have first as a practitioner is, can this model truly account for the complexity of our projects? So at the top of the slide on the left, I have listed some defining features of our PPPs, things like geography and sector. And I wonder whether the model can cope with all the diversity described here, for instance, regarding gearing, because lenders are an important stakeholders in PPPs, and I don't think you say much about lenders. And also, I've put on the top right part of this slide some pictures describing a few of our projects, just to highlight the diversity, even in a single sector. For instance, when you look at the airports, we have LaGuardia Terminal B Airport that some of you may use, but also Madagascar Airport in Africa, two very different assets, even in the same sector, because of the situation. And for instance, when COVID struck, we had to renegotiate in Madagascar because of force majeure, but not at all in LaGuardia Airport, because the contract is designed in such a way that the airlines had to pay a kind of rent, even if there was no plane at all flying out or in this airport. So very different situations, and I'm not so sure that the model can capture everything. The small table at the bottom highlights another layer of complexity, whether the project is structured through an SPV or not. And I think we have a little disagreement with the vocabulary used in the report, because based on our experience, we can have SPVs in PPP and in non-PPP projects, and we can have no SPV in PPP and in no PPP projects. You can have the four situations described here. I think it makes a real difference when it comes to renegotiation because of the governance difference. Who decides to renegotiate? It can vary a lot. And when you decide to renegotiate, for instance, lenders play a role in real life, and it's something that may somewhat overlooked in the model, I think. And now let's have a look at the data. So the good news again is that we do have data. It's not obvious, I think. The TED data you use is based on public procurement in the EU. So of course, I wonder how the findings can hold up globally, especially in America or in Africa, where are invested. Another issue maybe is how the data aligns or does not align with the classification system used by practitioners. And here I apologize a little bit in advance. It may sound like marketing, but the industry standard is the STIX framework shown here with its 4 pillars on the left. It was developed by IDEC and France Private, which also created a regulated infrastructure index that has become a global benchmark. So it's very serious, I think. And as a practitioner, I would love to see whether using that kind of classification could either refine your model or maybe strengthen the current regulations. And now let's have a look at the results on contract renegotiation. So I am a very candid guy, so I have to tell you the truth. I called in backup here. So the backup is the 4 people pictured at the top of the slide, or chief operating officers and CEOs for the Americas, Europe, and Africa. I did a little survey. So I showed them the main results of the study, and I asked them whether they considered the results were true or not based on their experience. In many cases, it was consistent, but in some circumstances not. So I have 2 slides, and the first slide here for the results is about what is consistent. For instance, statement 1, which says that renegotiation is more likely in the face of external shocks, while internal shocks have less of an impact. It's completely backed by my colleagues' experience, and I have written here their own explanations of this, which is sometimes directly linked to your model, but sometimes a little bit different. The same for statement 2, that says that renegotiation becomes less likely as the public partner gains experience. Again, it matches what we see. So I won't go into the details of their explanation. They are non-economists, but I was happy to see that their experience was consistent with your results. And now I'll jump to the more contentious points on the next slide. So here I would like to touch on statement number 3, which is more open to debate. It concerns how frequent, costly, and conflictual renegotiations are. So my panel of colleagues had mixed reactions, especially when thinking about our PPPs in emerging markets like South America and Africa. In those contexts, we often face unreliable public partners, cashless public partners. So I think it changes a lot compared to what you have seen in your database. So we have a lot of renegotiation drivers that I think your model does not capture. So no big deal, because in Europe, probably they are not that important. But if you want to draw more general conclusions, maybe it could be worth trying to address these issues. So I won't go into the detail. You have everything here, and you can see what supports and what does not support this result of your model, depending on the geographies. At the bottom of the slide, you'll see an example of an insurance product we purchase precisely to protect our investors when we invest in these risky regions. So it's a critical risk insurance provided here by MIGA, a subsidiary of the World Bank. And as soon as we have bought an insurance, it changes a lot renegotiation as well. And the issue maybe in Europe is that we do have insurances in Europe as well. And insurer is maybe a word that I have not found in your report. Lender, it was more or less the same. And I think when we want to understand what triggers renegotiation and the outcomes of renegotiation, it's important to take into account these 2 additional stakeholders, insurers and lenders. So to conclude, and I am perfectly on time, I think, so for the next discussant, we are happy practitioners. We have a global footprint at Meridian, but we are truly grateful for this research. And of course, we are a little bit frustrated because we would love to see more. We'd love to see more data with a broader set of countries. Maybe more alignment with market-based classifications, the TIC system I have shown. And maybe a suggestion for future research, it would be to focus on the internal governance of the private partner, because it is what really shapes how renegotiation decisions get made. And in your model, it's we decide to renegotiate, but who decides? We have different stakeholders here. Maybe we need to open a little bit this to better understand. But that's it for the European sample that you have worked with. The conclusions seem to align very well with our experience, as I hope I've shown. Thank you very much.
Thank you very much, Stefan. And I would like now to call on Giancarlo. Giancarlo.
Hi, thanks for inviting me to discuss this very nice report. I tried to share my screen because at the end I prepared some slides as well. And please let me know if you see my slides. Can you see the slides? Okay, great. So thanks for inviting me. I guess I'm here as a procurement specialist because I've been working in a procurement agency for 4 years, besides doing a lot of research after that on procurement. But I'm also here as I've been involved in the debate in Sweden on public-private partnerships 3 or 4 years ago, and I wrote a couple of reports on fossil around. Sweden is a very skeptical country about public-private partnership. For one reason is that they don't need it because they have very good public finances. But there was a big issue about accountability. It was very difficult to understand for the public where it was too much money, it was not too much money, and so on and so forth. So let me go into my comments on this report. So first, excellent. I like it very much. I think I agree on almost everything. And there is just a tone which I will comment before that I might want to suggest to change. So first of all, the investment gap is much larger than what we discussed until now. I had another webinar 2 weeks ago about readiness 2030 and new military expenditures, digitally creating a new independent European sovereign digital network. So the amount of funds we need kind of tripled in 3 weeks or in a month. And this report has a crucial importance also for that debate. In particular, it's not only about military expenditure, it's about innovation on this idea that we are lagging behind, okay? We're lagging behind because we are an investment. One reason, I just finished writing a survey on public procurement of innovation. And one thing that hinders Europe is that we don't have venture capital, okay? So in the US, you have public funding for innovation and a huge amount of venture capital, okay? In Europe, we have public funding for innovation, full stop. Public capital is very absent, okay? So one thing that PPPs can do is help filling this important gap on innovation. I think the authors should stress that this report is also very important for that literature. And by the way, Susanne Descochemer already in 2004 were discussing how important PPPs will be for innovation. I think it's a great time to stress this. So the model stresses the benefit of good renegotiation because we, as many economists have kind of assumed that renegotiation means abuse of renegotiation. There was a presumption that negotiation will be abused, and it's rightly so. Stefan, for a long time now, in a scientific article, is pushing this idea that lots of negotiation is actually for the good and is important. So fully agreed. And the result is about insurance, and the main result shows that if you allow this renegotiation to happen, you kind of provide insurance for unexpected shocks, and this reduces potentially also the cost of the project. And the complexity of the contract may be a limit to this negotiation. Although here I should note that sometimes the complexity of the contract is due to the description of renegotiation mechanism. So a lot of complexity in PP's contracts came to describe how renegotiation should occur. But of course, it explored also for other reasons. So about the empirics, I like everything that was stated. On the empirics, we learned that we don't know anything, as they nicely started describing. They did an heroic effort creating a new, very interesting data set, scraping TED and connecting it to this new variable on the balleting. There is an issue, of course, of as usual selection, which countries are negotiating why, and then the framework and approaches in different countries are very different, so you have very heterogeneous data in the same pool, and there are some complex interpretation of some of the results. For example, Stefan stressed that the strong, competent buyers renegotiate less, local authorities more. But then does this mean that negotiation is bad? Because it sounds like the opposite of the message. So I would, I think, sentiment analysis is another interesting issue. But if you think about the concerns in some countries about abuses, if there is an abuse of renegotiation, and I am favoring my brother in this renegotiation, we're going to be having very positive sentiment in our writings. So even more positive to hide if there is something murky. And the same thing for this cooperative approach. I mean, relationships, I've been writing a paper on relationship in public procurement. So I cannot be considered against relationship. That said, relationships are the same thing that enforce quality and enforce also favoritism and corruption. So then the problem means that cooperation can bite in different ways. And there are other interesting results. It's more analysis before you publish your other paper, because I guess there is an academic paper. But let me go to my final comments. So I'm playing the devil's advocate. I spent my career advocating for more discretion for public procurement, complex ones, and for more ex post monitoring rather ex ante rigidity. So now trying to do the devil's advocate, because renegotiations are a form of discretion, because they happen when there is no more competition and it's bilateral relations, and I could abuse it by favoring by renegotiation more, upwards the price with my favorite provider, but not with others, and this can be anticipated and can disrupt the bidding mechanism. So the report appears a little bit over-optimistic compared on this. I understand that you want to push this new result, but maybe you should also discuss a bit more the concern that is about accountability. Okay, it is true that in the past contracts were very, very simple. In the Roman Empire, they were extremely simple, but there was a lot of corruption. And in the last century in France, the contracts were very simple, but there was a lot of corruption. So, again, as Stefan said, we have to balance the two things, because rigidity and in particular the specification of how to renegotiate tends to prevent abuse of negotiation. And I agree with you that there is always there's been too much of a focus on negative renegotiation, but in this report, maybe because you want to push the point, you're a little bit maybe leaning on the other side. Two more points that I didn't see in the report. If we agree for simple contracts and relationships, we need to also agree that we need to monitor better the performance in terms of preventing possible abuses, maybe not in highly institutional countries like Italy or France, but in other countries, there is always the risk that this will. I mean, if I understand the UK experience, UK rejected, they were the main user of these PPPs, and they stopped because the public could not be convinced that there was enough accountability in the process. Okay, it was nothing else than the perception of accountability. And I think we don't want this to happen in the future in other countries. So we need to strengthen the monitoring system as well as giving more discretion. So more renegotiation and more oversight over negotiation. But what oversight? We need the oversight should be on the substance, on the performance, not on the procedure. And we don't have auditors able to do that. If you look at the national auditor reports in Britain that caused the big surge and the end of the private finance initiative in the UK, it was ridiculous. It was like basic algebra. I mean, there's no dynamics and so on. So we need competent auditors to do all this. We need stronger ex-post monitoring. And we need a very competent and reputable technical unit that is able to negotiate and renegotiate in equal standing with the supplier, particularly limiting consultancies' interference, which has been a crucial issue. I mean, consultants have always an interest for PPPs to go further because they get a large share of the consulting and of the cost of the contracting, and they act on both sides. So that will be another issue in the UK. So this last point I think is crucial, having a reputable unit that specialize and can take seriously renegotiation. Just to finish, I tell you what I tell my students on PPPs. If you think about in-house provision of by a state company of a big infrastructure, it's like having a Bernardiner to guard your house. And that, Bernardiner barks sometimes if there is a thief, but it's not very scary. It's slow and tends to grow too big. Then you can use public procurement environment. In public procurement, you get like Dobermans, okay? Dobermans are likely to be effective. They are lean and hungry, more scary, but they're more dangerous if they're not well managed. So you may need some training into how to keep your Doberman in the garden. A PPP is like getting a tiger, okay? Not a tiger, are very good guardians, potentially much more effective, but they are lonely animals. They tend not to lead to competition. And without long training in special skills and tools, they may eat you up. So, to deal with PPPs, you need a technical unit like tiger tamers and not local politicians, as it happens in Sweden and some other times. Thank you.
Thank you very much, Giancarlo. As a Brit, having lived through the massive expansion of PPPs, I can relate a lot to some of the things that you have said there. Now, everyone is free now. You are free to ask any questions you want. I see Mukhtar asked one question. Stefan, you have partly answered it, talking about, do EU policies help in PPP? Can I expand that question a little bit and say, should the EU be creating and generating policies to incentivize and encourage PPP? Is this a role for it? Who would like to take this? Emmanuel, Stefan, either of you would like to take this?
Then Stefan will jump in. I think first of all, I would like to thank both referee, make excellent comment, I think, and they are well taken. I believe there were, and very interestingly, there were some overlapping in them. It's clear that there are bad renegotiation, and Giancarlo has a nice report on Sweden that shows this difference between good and bad renegotiation. And the problem is exposed. Right? It's hard to tell ex ante what will be a good and bad renegotiation. It's clear that in developing country, renegotiation on average will tend to be bad. When governance is bad, the renegotiation are bad, and they lead to a lot of corruption, more easily at least. And that's our point. That's why the report focuses on the EU. The EU tend to have, compared to the rest of the world, better governance, I will claim. And that means we have an hope to create units that are efficient. And we have good paper on Italy that show that incompetence is a bigger danger than corruption very often. So for me, and we have this also in the data flavor of that. Some renegotiation seems to be very inefficient, not necessarily corrupt, but very inefficient. So I totally agree with Giancarlo that in his own report, advocate for creating curricula, really, to train. We don't have that in Europe. It's amazing. We don't have curricula that will train people to run PPP from the public side. And not having competent unit mean huge contract, 8,000 pages, trying to cover every possible contingency over the last 50. I mean, it's insane. So we need unit we can trust, and the people can trust because they are not corrupt. And that is possible. We have unit, for instance, taxpayers that are clean and that are doing the job. So it's not impossible, but we need to have them and to have them very professionalized. And that's something, it's technical, it's not simple. And I totally buy the comment that it should be exposed and not ex ante is really the end of PPPs. And we need the cash. So let's try to be creative. I will end the floor to my dear friend and colleagues. Stefan, the other Stefan.
Okay, thank you very much for all the comments. So, yeah, so maybe some reactions. So the first concerning the position of the EU concerning PPPs, I believe that PPPs they've got a very bad reputation for good reasons and bad reasons, but also because they are focusing on big amount project, and as soon as there is some issue, you know about it. But you've got plenty of traditional public procurement contracts that are also badly managed and that with plenty of cost overruns, and we don't really know. So I'm not sure the EU is pushing explicitly to develop PPPs, but by defining exactly what are PPPs through public procurement directives, they push for PPPs basically. And concerning the last directive, 2014, I remember that there was a huge debate about which sector should be excluded from the directive because some sectors should not go in the private end through concession contracts. So there was a huge debate around this. And I believe that by clearly defining what are concession, what are availability-based contracts, and how you should award those contracts is a way to push for more PPPs in the EU. But I'm not completely sure about this. I agree with Giancarlo concerning the fact that there is an elephant in the room, corruption. Obviously, I mean, the more you are negotiating, the more happy you are, and this is not. It does not prove that the contract is well managed and everything is good. I would say that one way to control for this or to avoid to have a better situation is to increase accountability, but I would say to increase information, transparency. And for example, you did not attack us today concerning the quality of the data, but TED data are. This is the best data we can have looking at the EU and looking at contract modification notices for PPPs and public procurement contracts. But those data are not, I mean, they could be in the better shape with more control and penalty for countries that are not doing the job or public authorities that are not giving the right information. So by increasing transparency, I believe we could avoid too much corruption if you give some flexibility to public procurers. This is my point of view. Concerning your other remark, I agree also, complex interactions, and I agree probably that the investment gap is really higher compared to what we believe for sure. But yeah, still in France we've got some debates about this. Concerning Stéphane, okay, so basically, Stéphane is saying you could do a better job going into the details. You know, COVID-19 sometimes because of the contract design, we are happy with COVID-19 and we are not losing some money, even if this is a concession contract, if I understood well. Even if you are paid by end users, you should be paid by end users. You've got some protection within the contract and so on. Okay, so we could go into the details. You can also take into account those PPPs with or without SPVs. Basically, what we did in the report is we provide a theoretical framework. So a theoretical framework is a simplification of the real world. We cannot go into so much details. And looking at the data, we control for as many things as possible. So we control for CPV code at 3-digit level. So maybe you've got some specific digit in which you've got some PPPs with SPV or without SPV. And we try to control as much as possible, but we don't have the data. But probably it would be interesting to make a focus on those issues. If you've got some data from Meridian, we are happy and happy to work with the data. Data on corruption or cartels, I don't know. we could go on it. Then that's true also that emerging markets might be completely different, and we've got some papers trying to distinguish renegotiation that are coming from public authorities or private authorities. I'm thinking about some papers from Stefan Straub on this issue. And that's true that sometimes public authorities are the opportunistic guy in the room, may benefit from private information and may push for renegotiation that are difficult to handle by private companies. So I agree. Thanks a lot for all those comments. Basically, this is my point.
Thank you. Stefan G, can I get a practitioner's point of view from you on Yossi's follow-up, talking about renegotiations? Do they tend to be backward-looking? It cost us more and it was more difficult than we expected it to be, so we're negotiating, or forward-looking, we expect this to be different in the future, therefore we are renegotiating?
From my experience at Meridian, I've been there for 3 years only. I would say that most renegotiations were forward-looking because basically the business plan that was conceived at the very beginning does not seem to be achievable for a variety of reasons. In Africa, it can be because of coup, for instance. It can be a very bad traffic assumptions, or it can be because the government, the authority suddenly decides that it would like to have an additional runway in its airport, or maybe catering services in the school we have built, etc. So adding additional layers. So far, everything I've seen was forward-looking and not really backward-looking, except if you consider that it's the present that is backward-looking because something is not aligned anymore with the original business plan.
Yes, okay. So do any of our other panelists have a point of view on that, or will we ask something different? Give us a hand if so. Okay, Mike, I have a question based on what Giancarlo was saying. A lot of the conversation, the unpopularity of PPPs in the UK was based around an idea of institutional capture, that the public bodies really were far too friendly with the providers. Therefore, negotiations were far too friendly, and therefore that did not lead to the best outcome. And I know Giancarlo said that what we really need are tiger tamers. How far are we away from having the appropriate tiger tamers that we would need for a massive expansion of PPP? Manuel.
Can you hear me? Yeah. Well, I believe this. So first of all, I hope it was clear for everybody that was on the chat today that the UK was one of the massive users of PPP, and especially they invented the ability-based contract. And okay, why? So I slightly disagree with what Giancarlo said about antiquity and PPP in antiquity. They were not corrupt. They were simply the reflection of non-democratic society. So you had king or emperor, and they give right to privileged people, and that's it. And I am the nobility of the corner, and I have a right on my river, and I do whatever I want with my river. So I give you monopoly right on the river. You do an infrastructure, you can exploit it as long as I want. That's really so this type of contract are not implementable today because we are in democracy and the public expects some control over this rent. But this contract was very efficient. They were very risky too. We have data, for instance, on PPP during colonial time. So you I give you a blank check to do some stuff in India, and you give me some cash in exchange, and that's it. If you do that, well, very often it was not profitable. So that was a very risky project with a very clear monopoly right and no cross subsidy between public and private. So here oversight is limited. For this ability-based contract, it's a bit different because you do a public a prison or a jail or an hospital, something that is very sensitive also because there are social services. And then you give some cash that is not risky really much because ability-based means if it's available, I give you some cash. And the example of the airport that was mentioned a little bit earlier is also one where the share of risk is not, I'm sorry, it was very good for you, but it was not very good for the public. I think it was not a good deal because if you have something like no traffic at all and you still have pay or take, type of contract, then it's a, so I believe in the UK there was a lot of that. And yes, maybe it was not so well controlled in the end. But there are other type of PPP that work better. For instance, Eurotunnel is not so bad, I think, because it didn't cost any public money at all, and we have this fantastic infrastructure. So that's, I believe, even if it was very risky for the shareholder, at least for the public, it was not so bad. So it depends really on me. I'm a big fan of PPP where the private sector takes some risk, especially from the demand, and get the cash flow in part at least from fees from the user of the infrastructure. That's for me a good PPP because it means you have to think really how profitable it will be, and you are sharing the risk. So that's rather bad PPP is one where it's this wide debt, let's say. I have no risk. I would get cash, whatever. That's my take on that. I let my co-author answer something.
That's something about LaGuardia Airport, because it's true that
We can't hear you, Stefan.
And now it works. I wanted to say a word about LaGuardia Airport, because it's true that we are not exposed to traffic risk in this airport, but you are exposed to construction risk and we are exposed to operational risk. So that's what we are paid for. And if you have experienced the LaGuardia Airport now, and if you have memories of what it used to be, you may have experienced the difference, and I hope you enjoy it. So it's what we were paid for.
Isn't it? Anything you do to LaGuardia improves it. We are over time, I'm afraid, that we have run out of time. But of course, all our panelists, you know where to find them. If you want to carry on the discussion, I'd say thank you very much to them. Thank you to Stefan and Emmanuel, and to the other Stefan, and to Giancarlo, and of course to Pietro. Thank you very much for all of you for attending. We hope that you found what you need. Please do read this report. It is very, very interesting, and it's certainly a subject that's going to be we're going to be returning to in the near future. So for that discussion, I hope I'll see you again. But for now, thank you very much. Goodbye.
Thank you very much.
Thank you. Bye-bye.
Bye-bye.
Thank you. Bye-bye.
Thank you all.